Problem 12-3. This was a little bit longer. Back to our journal entries, right? So on 505 is problem 12-3. Says the following is trial balance, and then it gives you transactions that took place during the year. Okay? Let's walk through these. Number 1 says contributions became due from the general fund, $38,000, and a special revenue fund, $6,000. 1/2 of these amounts is the employee's share of contributions. Okay? So there was $38,000 due from the general fund, $6,000 due from the special revenue fund, and those go in as additions. Remember, not revenue. Okay? You had half was the employer piece and half was the employee piece. That make sense? So 44,000, 22,000 was added for employers, 22,000 is added for employees. Do you guys have pension funds at your job? Retirement?
That's a good one.
Not defined benefit plans. You probably, none of you have any of those. But you may have contribution benefit plans. Yeah, right. Okay, so a portion you're giving, and then a portion your employer is giving?
Not for a pension. We just have a defined pension.
Yeah, a defined benefit. Okay. So you have a defined plan where you work.
Yeah.
Okay.
I have one from the previous year.
Okay.
My husband has a pension.
Yeah. Good.
Nice.
There aren't that many defined pension plans around anymore.
No.
That's the main thing that happened to GM and Ford and those auto companies, is they had defined pension plans, and it got to the point where people started retiring and they couldn't cover it. Right? Obviously, part of it was they weren't bringing in enough money, but still, they had built up these huge deferred pension liabilities, and they couldn't handle it. Okay? All right. So that's number 1. Number 2, payments were received from the general fund, $30,000, and the special revenue fund, $4,000. So you have cash, right, that's coming in to your pension trust fund. 30,000 of it was from the general fund, 4,000 was from the special revenue fund, collection of these receivables. Right? Okay? Number 3, securities were acquired for cash as follows. Now, you could have split this up into 2 separate entries. You could have done first purchase and second purchase as outlined. Okay, this is an aggregate entry. I put it all together. So in order to get this $35,150, you have to take the $20,000 plus the $15,000. Those are the 2 par value investments. Plus the $300 premium minus the $150 discount. Does that make sense?
Say that one more time.
Okay. In order to get this, I didn't do the math. In order to get this $35,150, you have to, from page 505, you have to take the par value investments and add those together. Plus, you add the $300 minus the $150 because it's a discount. Okay? So, those are your investments. You also purchase some interest receivable, right? Some accrued interest. You purchase that, that's going to be coming to you. So you paid $35,350 in cash for those investments. Does that make sense? Again, you could have made 2 entries, one for $20,300 and the $200 interest receivable, right? For $20,500 in cash, and then a second for $14,850. Does that make sense? What I'm saying?
I like that better.
So you could have made 2 entries, or you could aggregate them.
So you would put if you wanted to put the discount on there, you put it on the credit side.
Yes, correct. Yeah. Yeah, if you wanted to line them all out, you could. They would all go against your investments account, right? Because they're all part of your investments. Okay? Does that make sense? Again, when you set up if you're ever in the position where you're the one setting up a chart of accounts, you can make as many accounts as you want. You can be as detailed as you want. So you could make separate accounts for premiums, separate accounts for discounts. Okay, companies that deal most of the time in financial investments will have those separate accounts because they want to track that. Okay, accounting is all about what do you want to track, what story do you want to tell, and how detailed do you want that to be. Okay.
We have a GL for every single bond.
Sure.
And
Sure.
every single bond has its own.
Kind of sub-ledger investment piece. Yep. Because that's your business, right? So if somebody wants to look at your books, they want to be able to pull that out fairly easily. Okay. So if you're a business and that's your business, you can be as detailed as you want. Obviously, that makes your general ledger huge, right? So you better have a number of accountants that are doing it. For most small businesses, they're going to have a bunch of general accounts, cash, revenue, an expense account, right? If you're not interested in knowing exactly what those expenses are, do that, right? But if you're going to need to split those expenses out, you're going to have to go back into that huge expense account and find those each time. Does that make sense? Unless you make separate accounts. Okay? That's all part of creating a general ledger, making new accounts. Okay? Number 4. Interest received on investments amounted to $3,000, including interest receivable on January 1st, 2007, and the accrued interest purchased. So, our interest receivable at January 1st, 2007 was what?
$450.
$450, right? You're giving that up in the trial balance on 505. Okay? So, you're getting that $450, they're saying, right? You're also getting the interest receivable that you purchased in number 3. Okay? So, your interest receivable then is $450. Does that make sense? It's the $450 you had receivable previous from the trial balance, plus the $200 that you purchased as a receivable in number 3. The rest then is interest as interest addition, right? It's not revenue, it's interest addition. Okay? Make sense? Okay? Your cash was $3,000 because that's the total amount. So the difference is, again, your interest revenue, which is technically an addition here. Okay? Number 5, an employee resigned prior to retirement, was paid $300, which is the amount of her contributions and interest thereon. Employer contributions do not vest until retirement. Well, I doubt someone can live on that for very long, but okay, at least you got $300. So a deduction, right? Payment to resigned employees, you could have put refund here. And since they paid it out, you're going to credit cash. Okay? Number 6, retirement payments of $600 were made, which included the beginning of the year pension payable. And pensions payable of $200 remained at year end. So there's actually 2 pieces here. Okay? So the first part, retirement payments of $600 were made, including the pension payable. So if you look in your trial balance, you had a pension payable of $150 on your trial balance. So you had already owed that, right? So you're paying that $150 plus you're making a deduction of $450. Okay? We're back to generally the accrual method of accounting. Okay? So it's not as cash flow, you had already set up this payable. Okay? Paying out this other $450 in benefits, you pay out $600 in cash. Then the second piece, it says, pensions payable of $200 remained at the end of the year. Well, you paid off the payable here, so here you're reestablishing a payable. Does that make sense? So you're going to record a deduction and a payable, a liability. Right? To increase our liability, we're going to credit it. Right? So that means the debit is to our deduction. Normally, you would think of that as an expense. Right? Pension expense. But since we're in a trust fund, you don't. Okay. Number 7, an actuary indicated that the actuarial deficiency at year end was $19,000. No, there's no entry on number 7
Yes.
for the trust fund, right? You would record that liability in your financial statements, though. Okay, you would record that liability in your financial statements because that's still an unfunded pension obligation, right? But you're not going to record it here. You're not going to record it in this fund. Does that make sense?
So you record it in the basic financial statements?
You're going to record it basically in your non-fund, right? Because it's a long-term liability. That's what I was referring to. That's what I was referring to before when I said about the auto dealers. They had so many of these long-term liabilities. In their case, right, they're a for-profit business, so they don't deal with it in funds and non-funds and all that. But they built up that unfunded pension obligation so large that when people started retiring, they had to pay that unfunded pension liability, and they couldn't do it because they didn't have enough money. Right? They had a lot of inventory. That's great. Give somebody a car, not the same thing. Can't make your house payment with it. Right? So no entry for number 7. Number 8. The fair value of the pension plan investments was $200 more than the carrying value at year end. So our investment, right, our in essence asset increases $200, and our addition, net increase in fair value, is $200. Right? So again, if you think of this in accrual terms or in for-profit terms, investments would be your asset, and additions would be your revenue. Right? So it makes sense. Debit your asset, credit your revenue. Okay. In this case, we're using different terminology. And then you have your closing entries, just like you would have, right, anywhere else. You're just bringing down all the additions. You're debiting them because you're reversing them out, crediting all the deductions, and then crediting net position. Right? So if you think of this in a for-profit setting, you have all your income, all your expense, and your net income or net revenue. Okay? Questions on problem 12, what is this, 12-3?